Hello, I am Leyla Mansurova, Associate Professor on the Department of Pharmaceutical Technology and Management. I would like to present fourth lecture on our program of pharmaceutical economics. Our today lecture is devoted to accounting and accounting policy in pharmaceutical organization. Let's present plan of the lecture. First, of course, we will study definition and meaning of accounting as a type of activity. We little bit talk about history of accounting and bookkeeping, forms and functions of accounting. Then we will discuss users of accounting data, and I will introduce you to accounting metrics, measures. Then we will study objects and elements of accounting and particularities of accounting policy in pharmaceutical institutions. Let's start. Accounting sometimes is called language of business because main purpose of accounting is provision of information on business and its performance to different parties, to shareholders, managers, and other users. And second purpose is control and safeguard of the assets of the business, of resources of the business. Let me present definition of accounting. That's accounting is a process of analyzing, classifying, recording, summarizing and interpreting financial data of a particular business activity into understandable financial terms to facilitate business decision making process. The father of accounting is considered Luca Pacioli. He was merchant who lived in the second part of 15th century in Venice, Italy. Luca Pacioli presented his Summa Summarum book and he declared that successful merchant, Asian businessman, needs three things: sufficient money, cash or credit, good people, good persons who can save and take care about this money, and accounting system which allows him to view his finance in clear form. He declared that trial balance, summa summarum, is the end of Pacioli's accounting cycle. And he understood that if in your account bookkeeping recording system everything is okay, you will never lose money from your actives. And he said that that would indicate a mistake in your ledger, in your books, which mistake you will have to look for diligently with the industry and intelligence God gave you. As I said before, accounting is called the language of business because it's a vehicle for reporting financial information about a business entity to many different groups of people. In accounting, we use three types of metrics: natural, labor, and monetary. When we provide accounting of products, we use natural meters. In natural meters, we can count products, product volume of product, mass of product, number of products. When we provide accounting of labor resources, when we count salary, we use labor metrics. And in accounting, we use one universal metric, monetary metric, when we transform all our assets, all our resources into monetary term, because it's very easy to understand value of product when we count it in monetary metric, because we cannot understand. It's difficult to operate with 3 boxes of ibuprofen or 10 boxes of aspirin or 3 kilograms of some powder or 1 liter volume of some liquid. It's easy to operate with monetary term. When we see monetary metrics, something transformed into money, it is easy to comprehend. In accounting, we use 3 forms of recording of data: operative, statistical, and accounting or bookkeeping. Operative form of recording is important for controlling main business operations, daily business operations. For example, our prescription book is primary accounting document. This journal used for registration of medicines dispensed according prescription to final consumers. This form of recording helps to provide control of generally product circulation, and this information helps us understand daily business operations. Which metrics use in this form of recording? Natural, when we count amount of products dispensed. Labor, who worked, how many hours worked some worker. And monetary, how many products, on which sum of money products were sold during this day or this week. Is it clear? Operative or technical recording, first type of recording. Here you see primary accounting journal where dispensing of products is reflected. You see medication name, for which reasons it used, prescribed by name of prescriber, of course date, and unit of product, strength, dosage, and dosage form, and etc. Statistic recording is different kind of recording which use for studying of total transactions and relations between them. With the help of this method, we can analyze dynamic in business activity. For example, we can compare number of patients during 1 month and other months, or during years, their demographic characteristics. And this data of statistic recording reflects not only quantitative but also qualitative parameters. Dynamic of sales. These parameters are also very important for analysis of business activity. Dynamic of sales during a year or during several years, average salary, and etc. They could be subjects of statistic recording. Which metrics used here? Usually monetary and labor. And universal method and most important method of recording is accounting. I would like to repeat definition of accounting. It's the art of recording, classifying, summarizing, interpreting in a significant manner and in terms of money, in financial terms, transactions and events which have financial character, which affect on business, and interpreting the results thereof. Accountancy is a process of communication financial information about business entity. This definition is given by Eliot. Two types of accounting exist: financial accounting and management accounting, and they use for completely different purposes. Financial accounting covers reporting results and financial position of a business, and its primary task is not related to provision of information for improvement of business efficiency and management, but only to satisfy information needs of interested parties, which could be involved or not involved in business management. Financial accounting provides only historical information about past. And for provision of this information exist strict forms of special journals, special ledgers, special financial statements. Management accounting is used for completely different purposes. Management accounting covers provision of information to the management of business for business planning and controlling. And this information includes not only historical data, but also some information for future, forecasted or planned information. And for this kind of accounting does not exist any strict form of report, because this information could be presented in different forms, in form of statement, in form of plan, like this. Accounting process. Here you see sequence of process. First, this process starts with analyzing of transactions and determine what impact they have onto the business. First, on first stage, we need analyze transaction, which effect, which impact this transaction has on business. When we say transaction, we mean some kind of buying, purchasing, or selling operation, or payment of salary, payment of rent, buying of product, paying for loans to banks. On second stage, we record transactions which have impact on business and its financial results. This recording could be in primary accounting documents, in books or secondary ledgers. On the last stage, we summarize recorded transaction, prepare special books, ledgers, and as result, final result of business, financial statements. Business transactions first are recorded and analyzed in the books of prime entry. Examples for books of prime entry are journal for dispensing products, journal for returns of dispensing of sold products, or book for purchases, or book for return of purchases. These are books of prime entry. Second level of documents called ledger. The totals from primary books is moved to general ledger account. It's secondary level of accounting documentation. And at last, all transactions are summarized in the financial statements. It is a result of financial activity, financial statements. Examples of financial statements, here you see balance sheet and income statement or profit and loss statement. Who are users of accounting data? Users could be external people, organization who don't work inside the company, inside the business organization, and internal workers and managers and shareholders of organization. On the next slide, you see different kind of users of accounting data and financial statements. Here you could see also external and internal. Management of organization, internal user. They are responsible for day-to-day business management. They need information about financial situation of business, current and expected in the future. Shareholders, owners of the business, they also consider as internal users. They use information to assess performance of the management, to analyze and give directions to management. Trade partners, suppliers and customers, they are external users, suppliers who supply products, customers who buy products. Suppliers selling goods need information on security of their sales and of future payments. Customers buying goods need information on security and stability of their purchases. They should be sure that next time they could give back product if something is wrong or buy same product in the future. Creditors, also external users, they need accounting data for assurance that loans granted to the business and interest on the loans will be paid on time. Taxation authorities, also external users, they use accounting information for assessment and calculation of taxes. Employees, internal users, they need assurance on security of their jobs and future career perspectives. They also are interested in stability of business. Financial analysts, advisors, also external users, they use information to provide services to clients, investors, for improvement of business. Government, institutions, public, also external user, they use this information for some statistical purposes and etc. On this slide, you see the structure of system of business recording. That's information about business activity, about business resources, analyzed impact, use, and present in form of documents, and this the purpose of this process is decision making, making decision toward improvement of business, stability and improvement of business. This information use, you see, feedback for analysis of information about business activity and could be used for planning and forecasting for next period. As subsystems, you see three forms of recording: operative or technical recording, statistic recording, and accounting or bookkeeping. These three kinds of recording are considered as subsystems of business recording. Each subsystem exists from elements. Element for operative technical recording are operative documentation, as I said previously, books of prime entry, some ledgers, some registration journals. Element of statistic recording is statistic documentation, which used for analysis of dynamic of business. And subsystem of accounting is accounting documentation, which used for analysis of financial data. In accounting, we use different methods. You need to know them because the knowledge of these methods is very important for safety of your business. First method, documentation or recording. All information about business or financial data should be collected in some forms. These forms could be different: paper, digital, other. And this information reflects business activity of the organization. That's first method, documentation or recording, and this method shows us that all information should be reflected in special journals, in special books, in special paper or digital forms of information. Second, evaluation or measurement. This method is about transformation of assets of business, of resources of business and business operation from natural meters into monetary meters. For example, if company has a car for transportation of some products, this car is considered as asset, as resource of business. But in accounting documentation, it should be reflected not as car, Volvo in gray or black. It should be transformed into monetary metric. There should be sum of money. How much cost this car for business? Third method, calculation. The purpose of this method, determination of total costs of assets of business, of resources of business and business operation. When company assess all costs of assets, of resources, how many assets, how many resources, different kind of resources business has, and what is the total sum of money, how much business really has. Inventorization. Inventorization is comparison between real data and data in accounting documents. How does it work? When during inventorization, manager or other worker compare how many products they have on their storage place and how many products are reflected in accounting documentation. And if amount of products is same, it means that in our accounting system everything is okay. If we have any mistakes between real data and data in accounting document, it means that something wrong with our accounting system. Then, next method, double entry recording or double entry bookkeeping. Reflection of business transaction on two accounts, debit and credit. We will talk about it later. And the last method of accounting, preparation of statement. As I said, final result of accounting process is preparation of statement. Is a process of aggregating accounting information into a standardized set of financials, because statements exist in strict forms of special information: balance sheet, income statement, owner equity statement, and cash flow statement. Which forms of accounting exist? According purposes of recording, for which purposes we record information, information could be chronological, organized by some periods, systematic, daily, weekly, monthly, annually, or mixed. According to composition, information could be presented in form of synthetic register, division by similarity, grouping of transactions in monetary terms, and analytic registers, which use for analysis. According to design of documentation, forms of accounting could be presented in form of special journals, cards, ledgers, books, tables, statements. Three types of financial statement used in accounting. Not three, normally four, but these three are most important for business operations, for business activity. They are balance sheet, income statement, and cash flow statement. Balance sheet reflects structure of company's assets, actives, resources, and financing sources used to finance these assets for particular date. Balance sheet does not prepared for period. We cannot prepare balance sheet for 1 year. We can prepare balance sheet at the moment, for example, at the end of the year or at the beginning of year. And balance sheet show us the structure, like snapshot of our business actives, what our business really has. Income statement. Other name of this statement is profit and loss statement. This statement reflects results of company's operation, income and expenses as a result of profit or loss for particular period of time. Income statement never prepared for one date. It should be prepared for one period. Usually, income statement is preparing for 1 year annually at the end of the accounting period. Income statement could be prepared for 1 month and reflect result of company's operation for 1 month. And third statement, cash flow statement, is a statement which indicate how cash position on a company changed over a particular period of time. That's, you see, income statement and cash flow statement. They should be prepared for one period of time, some period of time. Balance sheet is prepared for one date. It's snapshot, like picture of business. Here you see 4 types of income statements, balance sheet, and how and which important terms should be reflected there. Balance sheet is a tabular sheet of balance of assets, actives, liabilities, payments, and equity capital on the one day, for example, on the 31st of December. Which terms should be reflected here? Assets, liabilities, stock, earnings, etc. Then, as I said before, and I would like to repeat, that balance sheet is prepared for one day, for one date. Income statement, statement of calculation of income, profit and loss of a particular period, and which terms are reflecting there: sales, operating costs, interest cost, amortization, taxes, net income, like this. Statement of cash flow is also prepared for one period, and it's simply statement of cash generation, and it used categorized under different activities. How much, if we use some simple words, how much money we had at the beginning of accounting period and how much we have at the end of period. Our cash flow is positive. It was increased or decreased or negative. On this statement, operating activities should be reflected, investing activities, financing activities. And statement of owner equity or shareholders equity. This statement also prepared for periods, some accounting period, usually for 1 year, and it shows the capital investment by shareholders or owners and retained earnings of the company. In simple words, how capital equity was changed after accounting period. Not if cash flow statements show how cash money changed. Owner equity statements show how capital was changed. During this lecture, I several times repeated assets, liabilities. Now I need to introduce some basic terms which used in accounting. First, assets. Assets are actives of business, physical, tangible, or intangible items which have a monetary value and owned by the business. In simple words, assets are all resources of organization, from places, premises, from equipment till products, dishes, and other things. Investments which could be used for future, and intangible assets, intangible non-current assets, license for your business. What means license? License is permission for pharmaceutical provision of pharmaceutical business activity. From one side it's nothing, just paper, but from other side, with the help of this license, you could provide your business activity, you could provide your business operations. It's intangible, non-current assets. Here you see classification of actives according their composition and accommodation. As you see, actives of organization. When we say active, we mean resources of company. Non-current assets divided to fixed assets, buildings, transport, and intangible assets, patents, license, brand names. Current assets, which could be easily converted to money, products and stock, normalized, they have some form, and money, shares, futures, cash, non-normalized because they exist only in form of money. And deferred actives, reserves of business, income, budget. We also could use this type of active, but not in same way as non-current and current assets. Classification of actives according their resources. Actives could be personal and involved. Personal actives means they belong to organization. Involved, attracted, they taken from third party, from other side. As personal active, we could use charter capital or income, special funds, social funds, budget and non-budget financing. Involved and attracted actives are long-term, short-term bank receivables, long-term and short-term bank payables, some payments for products, payments, salaries to workers, and etc. The other basic term which used in accounting is liability. Liability is a company financial obligation, money amount which company should pay, owe to third parties. Examples of liabilities include loans payable, accounts payable, salary payable, taxes payable, and other. But here you see examples for liabilities. Something which you should pay to another party. Leases, car loans, money for products, for services, salaries, and other. Classification of liabilities. Liabilities are divided to current liabilities or short-term liabilities, non-current liabilities or long-term, and contingent liabilities. Current liabilities, money which company should pay in short period of time, period less than 1 year. Accounts payable are current liabilities. Salary, payment for salary, rent, and like this. Non-current liabilities or long-term liabilities should be paid for period 1 year and more. Money which should pay for loans to bank and like this. Contingent liabilities. Interesting form of liability which should not be exactly paid. For example, if any business organization provide transportation of some product and in their contract they have some part about contingent liability in case of force majeure situation or natural disaster, earthquake, who should pay for when this problem exists. These liabilities are contingent. They should not paid for advance. They paid only if something happened. The third important term which used for accounting is equity. Equity or capital is residual claim against total assets of business after all liabilities are deducted. It means that capital is sum of money which really belong to owner of business. Equity represents right of the shareholders or owner to get share of assets the business owns after all liabilities have been paid. Here you see classification and sources of capital, sources of owner's equity. It's owner capital which businessman or owner had before starting to the business. Retained earnings from previous business operations. Current earnings from last business operations. Drawings or dividends, money which are taken from the business for any personal needs, not for investments. Here you see the essence of accounting, which called accounting equation. Accounting equation shows that assets, actives of our business, equal to liabilities, our owings, and owner equity. Resources which we use for business, we cannot say that they are our resources, they belong to us. For example, products in stock. Normally they are assets, actives of the business. With the help of this product, we could provide our business. For example, pharmacy, retail selling pharmacy has some product in stock, but it's asset. After paying of supplier some amount of money which we should pay for inventory cost to supplier, after we pay these liabilities, the rest part of these assets is capital. This part is really belongs to business owner. Balance sheet, important financial statement or statement of financial position, which prepared, you remember, on one date, reports company assets, liabilities, and owner equity. That's balance sheet based on accounting equation. The form of balance sheet. On the left side, you see assets. On the right side, you see liabilities and equity. You need to know that in accounting, these parts are every time placed in this way. Assets on the left side, on the debit side, liabilities and owner equity are always on the right side, on credit side. Here again you see components of balance sheet, assets on the left side, liabilities, our owings, right side, and rest is equity, or in other words, what the business is worth. Assets, what the business has, owings, with the help of the assets owner provide his business. Liabilities, what the business owes to other parties, and equity, what the business is worth. As I said previously, one of the methods of accounting is double entry recording. Double entry system provides two equalities or balances. And first time Luca Pacioli offers use this double entry system. Here the principle of double entry bookkeeping system is that any transaction should be reflected on two sides, left side and right side, debit and credit. It does not correct to say that debit is good, credit is bad, or opposite. No, debit is left side of account, credit is right side of account. In balance sheet and income statement, debit and credit are used for different purposes. In balance sheet, assets and assets accounts which debited when they are increasing, liabilities credited when they are increasing. In profit and loss statement or income statement, expenses accounts every time debited and are debited when they are increasing. Income or revenue every time credited when they increasing. That's the parts of debit and credit. Debit, assets, expenses, credit, liabilities, revenue or income, and owner equity. Here again you see double entry accounting example. Assets on the left side, debit. When they assets debited, they are increased. When they credited, they decrease it. Liability, when they debited, they decrease it. When they credited, they are increased. And owner equity, because owner equity stay on credit side. When equity credited, it increase. When debited, decrease. Same for expenses and revenue in income statement. That's the result of accounting process is preparation of financial statements. Objective of financial statement. They should provide information on financial position, performance, and change in financial position of a business to a wide range of users to make economic decision. Each financial statement used for different purposes. Balance sheet show to owners, to managers, to shareholders, to other parties what business really has and sources of these actives. Balance sheet includes assets, liabilities, and owner equity. Income statement show business activity, profits and loss for some period of time. Cash flow statements show how cash flow changed during some period of time. On your practice lesson, you will study and learn preparation of financial statements more particularly. Here you see accounting cycle, which show each stage in this process. That's first analysis and journalizing of transaction, analysis of their impact on business. On next step, we provide some summarizing accounts in form of general ledgers. After that, we prepare trial balance and provide adjusting according periods in trial balance, adjusted trial balance prepared. After that, prepared financial statements such as balance sheet, income statement, cash flow statement, and owner equity statement, and closing of general ledger account, and preparation for next year, because information from closed general ledger is going to information from last date of previous period is moved to first date of next period. Again, you see here accounting cycle and how reported. In accounting, we use two different methods. We could use cash basis accounting and accrual basis accounting. The difference between them is only reflection of information. In cash basis accounting, information recorded in special books and journals at the same time as it happened. For example, you sold product and customer haven't paid yet. In cash basis accounting system, you can record your sale only after customer paid for his purchasing. In accrual basis accounting, it does not matter what time customer paid to you. When you sold product, you record that you will get some amount of money. You see the difference between these two methods, what time information is reflected. In cash basis accounting, information reflected only when payment happened. In accrual basis accounting, only when business operation transaction is happened. The cash method is the more commonly used method of accounting in small business. Under the cash method, income is not counted until cash or check is actually received, and expenses are not counted until they are actually paid. Accrual method. This method, when transactions are counted when the order is made, the item is delivered or service occur, regardless of when the money for them are paid. In other words, income is counted when the sale occurs, not when money paid, and expenses are counted when you receive the goods or services. Both of these methods have their advantages and disadvantages. Advantages of accrual method. While accrual method shows ebb and flow of business income and debt more accurately, it may leave you in the dark to what cash reserves are available, which could result in a serious cash flow problem. For example, in your document you see that you sold product on $50,000 and you reflected in your accounting documentation that you received $50,000, but really you don't have this sum of money. That for cash flow it's problem, because at the moment you don't have these $50,000. Income ledger may show thousands of dollars in sales, while in reality bank account is empty because customer haven't paid yet. But this accrual method is used by big companies, big organizations, which does not need to have cash money. They need only see dynamic of their business operations. Cash method. Cash methods provide more accurate picture of how much actual cash your business has, and it may offer a misleading picture of longer-term profitability. This method is used by small business organization, and it's okay. It shows real picture of your money, but it does not show total picture of your business operation. Maybe at the moment you have enough cash, but you should pay rent, you should pay salary, and after 1 week or 2 weeks your profit and loss statement shows that you did not get profit during this period, but really you have some cash of money, which can provide misleading information. Under the cash method, books may show 1 month to be spectacularly profitable when actually sales have been slow, and by coincidence a lot of credit customers paid their bills in that month, but next month's picture will be completely different. It's the end of our lecture. I hope that you are okay in your home countries, and I hope that you will come back and we will meet in Baku on our lecture room. And I think that you understood this lecture. If you have any questions, don't hesitate to contact me. You could send your questions on my mail. Thank you for attention.